Hello. Today is Monday, June 8th, 2026. Here is your daily signal. According to Bloomberg, gold prices posted their largest drop in 2 months after strong U.S. jobs data fueled expectations of Federal Reserve rate hikes, roiling both the commodity and bond markets. U.S. jobs data, reported monthly, remains a critical indicator for global financial markets and traditionally triggers swift reactions in gold and treasury yields. Notably, this May's robust numbers have magnified that volatility. The U.S. economy added a staggering 172,000 jobs in May 2026, nearly double the forecasted 88,000, which sent gold prices plummeting on June 6 and pushed bond yields sharply higher as investors braced for tighter monetary policy. Higher bond yields may, in the near term, escalate borrowing costs for companies and consumers, while volatility in gold could persist as investors reposition in anticipation of possible Fed moves. Sustained employment trends may prompt further Federal Reserve tightening later this year, potentially generating broader volatility in global commodity pricing and supply chain hedging. Turning to fiscal policy's effect on U.S. mortgage rates, Fortune reports that mortgage rates have remained elevated at 6.48%, not due to Federal Reserve decisions, but because the U.S. Treasury is flooding bond markets with new debt, following President Trump's tax and immigration megabill. The jump in the deficit, now up by $3.4 trillion, has propelled Treasury yields higher, increasing the supply of government bonds and making borrowing more expensive for households. On June 5, 2026, Fortune detailed how the latest bill is directly hiking mortgage rates as bond investors react to the influx of new debt and worsening conditions for borrowers. In the near term, this means home affordability remains constrained and the housing market is likely to slow. Persistently high deficit-driven debt issuance could also boost borrowing costs for the broader economy and federal interest expenses over time. Financial markets may experience heightened volatility, with tighter credit possibly spilling into other asset classes and affecting overall economic stability. Next, TechCrunch highlighted a landmark deal as Google agreed to pay SpaceX $920 million per month for compute services, coming just a week ahead of SpaceX's historic IPO. This record-setting agreement cements a growing synergy between cloud and space companies, with Google aiming to capitalize on SpaceX's infrastructure as a foundation for next-generation compute. The deal, finalized in early June, is among the largest monthly technology contracts ever, and both firms are set to benefit. Google strengthens its cloud competitiveness, while SpaceX's imminent IPO and revenue surge may bolster its valuation and market confidence. In the coming months, this partnership is likely to accelerate public-private collaborations on advanced space and cloud tech and prompt other major tech players to pursue similar high-performance compute solutions. Now, onto the markets. International stocks were mixed, with Netherlands notching a strong gain of 1.7% and Netherlands also the top gainer, while Chile fell sharply by 2.1% as the weakest mover. Commodities saw gold add 0.5% to 434.65, while platinum retreated 1.8% with platinum as the top loser. In the S&P 500 sector, the index edged up 0.6% led by semiconductors, which rallied 6.6% and SOX as the leading ticker. Among favorites, AMD jumped 5.2% as the top gainer and Axon fell 2.9% as the top loser, with Microsoft declining 1.6% on weak momentum. Gainers included FAC surging 1,597%, IND up 1,366%, and IPFs were rising 176%, while RMSG plunged 60% to lead the losers, followed by SCAG sliding 58% and HUC dropping 54%. That's it for today. You can find more news and details on our website. Goodbye.